each farmer needs to know their own cost of production. So the last part here is to think about what do you do? You know, you're in this tight market. You look ahead to where the prices are going. You look at your cost structure, look at it, and you decide, you know, it's going to be tight for 2-3 years at least. So how do you deal with these long periods of expected tight margins, negative margins? Farmers have to deal with this all the time. You have to have a plan. It's going to happen to you if you're in farming for any period of time. Go look at those extended periods of time in the 80s, the 90s, and now when prices are well below the cost of production. A couple big things we want to talk about: just knowing your cost of production, then developing a marketing plan. And then we'll have some more stuff in the next slides. But your cost of production, you got to know what you're spending your money on, and then think about each of those inputs. You got to really look at them. I'm spending how much on fertilizer? Do I need that? They talk about all these budgets. They talk about these different tools, estimate how much fertilizer I should really need. I got manure crediting. I got legume crediting. Those are free fertilizer from legumes. Manure, it's cheap relative to maybe buying fertilizer. Herbicides, do I need to spend that much money? How much am I spending on seed? Look at the data, look what other people are recommending out there, the scientists, the extension specialists, the agronomists. What am I spending? What are they saying I should be spending? It's just knowing your cost of production, optimizing those variable input costs. The other thing you got to sit down and do is look at outsourcing some of your activities that you're doing yourself. That tool, partial budget analysis, is very good. Selling machinery is one option. Just get rid of it and pay someone else to do it for you, a custom operator. Oftentimes, if you're a smaller operation, your machinery complement is higher cost than if you paid a custom operator. Do a partial budget analysis and see. You might have some extra costs because of yield declines or just being late and stuff, but it might pay off. Keeping machinery longer or sharing machinery is another one. People who have done that in the past, you work together with neighbors. It's one way to bring that fixed cost and spread it over more acres. Two smaller farmers can share a piece of equipment like a manure spreader, a big liquid manure spreader, or maybe a corn planter, and just work together to share the scheduling. And now they've used that planter over more acres, and so those annual fixed costs are spread over, so you're spread over more acres, so your cost per acre goes down. The other thing is, instead of selling, maybe you decide to take on extra work. You have your corn planter, but you're going to do custom work for neighbors up to another 1,000 acres, let's say, or some number like that, in order to, again, spread your costs over more acres of those fixed costs of owning that planter, the combine, whatever. So your own personal costs are lower, and you bring in some extra cash. Same thing, you can use your yield monitors. A lot of these combines have yield monitors on them. Even if you have custom operators, they'll give you the maps. You can see how much you yielded where in the field. And you can quickly identify, I've seen these maps, you can see where you're getting low yields year after year. Stop farming those areas. Maybe it's a wet area. Maybe it's a sandy knoll. Why are you spending $600 an acre to grow a crop there that you're only going to get $400 worth of revenue from? Identify those areas. You can calculate your break-even levels and figure out where to stop farming. Stop spending money there. You can also, this happens a lot, where you have to switch to crops with lower overall costs to put in. We went through those budgets. You saw soybeans was much lower than corn in terms of operating costs. This happens where farmers, especially a few years ago, would go in to get their annual operating loan. They got $1 million worth of costs to put the crop in the ground, and they need to borrow some of it, say $300,000-400,000. The bank says, you want $400,000, we're only going to give you $2 million. And the farmer's like, oh, what do I do? One of the things to do is look for crops that cost less per acre to put in. Corn's an expensive crop. Look at other crops. Maybe grow more soybean, grow more wheat, or hay or forage crops. Things like that have smaller costs of production to put in the ground, so you have a smaller operating loan. Instead of taking on so much financial risk, you back off a little bit. Also, you do run into this, high risk, high reward, low risk, lower reward. So maybe your returns go down, but you're also reducing your risk. The last part you can also look at, you look at your cost of production. One of those is land rent, or an opportunity cost. If you're renting it from somebody, you can negotiate lower land rents. The other one that people were starting to do is shifting to these flex leases that were based off of the yield, or the yield and price, the revenue per acre. And what you do is you share, as the revenue and the yield go up, you pay the the landlord more money. And so the rent is a flat rate of $100 an acre plus, $1 for each bushel the crop is over, 200 bushels per acre, something like that. That's what they mean by these flex leases, where the landowner shares in the upside potential. You give up some of that potential gain, share it with the landlord, but you also then reduce your cost, especially if you have low yields. or low revenues if the price ends up being low. The other one is developing a marketing plan. Over my years of experience in this, marketing plans and having a good job of marketing, a lot of farmers don't do that. They love to grow crops, love to be with the animals. They don't like to do marketing plans. There's lots of online resources out there on marketing plans for grains. Extension services offer them. The county agents or state level agents in Wisconsin and other states. There's marketing clubs. Farmers join together. You can even hire services. You can work with a local co-op or someone whose job is just selling grain and working with somebody, has several clients and helps them sell grain, develop a plan, and get an extra 5, 10, 15 cents per bushel on average. The idea is to get that better price. Either you do it yourself or you hire someone to help you do it. They get you an extra 20 cents per bushel on average, and you share 5 of that with them, and you get the other 15 or something. I don't know. These pricing structures are different than that, but that's the idea. Increase your average price. Instead of adding more production, increase your price. That's one way to do it. And I think there's a lot of farmers out there that could gain from improving their marketing and that's why we have our course in the Department 322, how to do grain marketing is a big focus of that. There's some basic rules and ways to improve your overall sales average price. So you got those two. The other one is just to accept below average returns to survive for future profits. That's pretty common. How do you get through these cycles? Is you just weather them. You know you're going to lose money. You're working really hard and earning $25,000 a year, but you do that because in 2-3 years you're going to make $180,000 a year or something like that, some big number. And on average, your income will be okay. What your own personal goals are. In the short term, though, you're going to have to figure out how do you survive these years where you don't make enough money. Can you add your off-farm income to cover family expenses? Do you have to, sometimes a spouse or even the operator will have another job, pick up some extra hours, totally unrelated to ag, or it could be as simple as doing more custom work. The other thing is part of what you're doing there is going to be eating your equity. Your operation will have equity built up in it over time, and your lender is going to have to let you borrow against that and reduce your equity. You're going to go backwards on your debt to equity ratios and things like that. And that looks like things like you've got an operating loan, you borrow $300,000 to grow a crop, and you're only able to get $200,000 paid back. That extra $100,000, you have to refinance and bury it back into the farm mortgage. Or the same thing with your rolling line of credit. Maybe dairy farms often do this, or they make up a number again, $100,000 as a rolling line of credit. It goes up and down. You pay it down when you get your checks, and then it builds back up again. You pay it down, back up and down on a monthly, bi-monthly, every 6 months basis, whatever you operate in. Well, eventually you keep going like, wow, we used to pay that off all the time, and now it's like a credit card debt, if you will. And now we haven't been able to pay it off, and we actually need a little bit more. So then you refinance. You take that rolling line of credit, bury it back into the mortgage, and get a new $100,000 line of credit or whatever you have. And we talked about using these identifying unprofitable areas in your field to stop farming them. I still think there's a lot of gains there. I've heard a lot of precision agriculture people talk about that. And then the last thing here is the University of Wisconsin Extension. We did these over a few years ago because this got really bleak a few years ago, where we had these grain market, these negative margins in the state, nationally. And so we developed a video series for the county agents and just for people to use to watch, some ideas of how to deal with these low prices. And then a special 4-page document you could use, like a handout that sort of summarizes some of the same things. We'll take a look at those. But the other part I want to focus in on is this little picture on the right side here. It shows you, we talked about these equity issues, or we talked about these averages, but some make money, some lose money. It's always hard to know what's going on. And so the Federal Reserve System is pretty good about this. And that's what these are from. This is from Dave Widmer at Purdue University, but he's just using federal data. And you can look at farm debt over time. And the orange line is non-real estate debt. That's going to be your operating loans. And the blue line is real estate debt. That's your land loans, if you will, to borrow money to do the land. And you can see the non-real estate debt, the operating loans have been rising since the mid-90s up until 2018. But you can really see in the last few years a big shoot up in the real estate debt. That's very much an example of eating your equity, refinancing and burying these operating loans you were never unable to pay back, these rolling lines of credit that you couldn't pay back, burying them into the farm mortgage. And you see we've broken into the levels of debt that we haven't seen in a long time by doing this. So that's how we track these more broadly in an industry. Is might not know what's going on each individual farm, but you see numbers like these from the Federal Reserve banks, and Kansas City, the Minneapolis Fed, the Chicago Fed, those St. Louis Fed. They all track different parts of the country, and you can quickly see this has happened to a lot of farmers. And then you can call the ag lenders and get a sense of what types of farms are having troubles, and you can start to see that yes, this is a sign of financial stress that's going on out there. So I'd like to quickly look at these examples of these materials, and then we'll come back. These are these documents we looked at over here. On the left is the web page. We just did a lot of videos, different people from the soybean agronomist, weed management, soil fertility, corn agronomist, disease management, insect management, machinery management. I did some stuff on partial budgeting. And they all each have a video. County agents get together, growers, and they would watch these videos. Over here is the handout that would go with it. This is a 4-page document. I'm just scrolling through it quickly. And one page is the economic stuff here about developing a marketing plan and knowing your cost of production. Talking to farm lenders, ag lenders, and it's just amazing how many farmers don't know their own cost of production. They just have no idea. They haven't done it in a long time. And so when times are good, they don't worry about it. But when times are bad, they come back to it and having to do this. And so the ag lenders, a lot of them end up working with their farmers, their clients, to help them estimate their cost of production. And so if you end up in ag lending working, don't be surprised if you aren't spending a lot of time helping farmers develop a cost of production estimate that fits their operation. So the long-term reality in agriculture is that the number of U.S. farms in the U.S. has been declining since 1935. The average farm size has been increasing. Herd size has been increasing. That's just what's been going on for decades. Farmers face continuous pressure from these consolidated input suppliers and the output buyers on each side of them. Think back to that U.S. food system, how consolidated it was at different ends. And then there's this group of farmers in the middle that are facing consolidated suppliers and consolidated buyers, and they're that funnel that the food funnels through. I'll spend some time later in the semester covering this something called Cochrane's treadmill and and the impacts of technology adoption, adopting new technologies that raise your yields, lower your price per bushel or per hundredweight, and why farms have been focusing on this for decades. The cost efficiency that drive that creates something called Cochrane's treadmill. We'll talk about that. There's also a lot of inelasticities, non-responsiveness that creates these periods of time when you can make money in good times, but you endure low returns in bad times. And so on average, you should expect a normal rate of return. But part of it's driven by these inelasticities in the market, and we'll talk more about that. But those cycles up and down, that's part of agriculture. And land and managerial ability are the essential assets that allow them to make money when the times are good and survive, not go so negative when times are bad. And so we've been seeing these tremendous pressures on farms for decades. And the last point I'd like to make is that agriculture is like a lot of businesses, and it values relationships. And if you're going to be working in ag business with growers, you want to be aware of these financial realities. Like this figure here, that gap, and how many of them are starting to refinance, and they're under a lot of stress. They're not covering their operating loans or their rolling lines of credit. You want to be aware of those kind of things that are going on, these ups and downs, and be ready to work with them in hard times. And then they'll probably remember you in the good times. And that's part of being in sales, or being in ag lending, or being an insurance agent with these individuals. You work with them in their times of crisis. And sometimes it's a lot of your clients who are going through these, and it's just a part of agriculture. So I hope you got a sense from this video of some of these learning goals, of the scale of operations, how many dollars these individual operations are throwing around. Basically, they spend a lot of money and they sell a lot of production. There's a lot of dollars flying around. Farmers go through these tough time periods when things are tough, and then also when they're good. All farms deal with these times of financial stress and crisis. And if you're going to work in agriculture, in the business supply chain on either end, it's part of what you're going to be dealing with. And then we briefly explored some management options for farmers when facing these thin or negative margins. It's just simple stuff like knowing your cost of production, optimizing your input use, partial budget analysis, things we've been talking about, things we will talk about, the farm finance, but there's a whole nother class in ag finance, and then